Are we headed for a financial disaster? Let's talk about it. So it seems like it has begun, the financial collapse of the United States, and it begins with two banks. I think those are the first signs of it. You've been hearing about a depression type incident coming. Some people will say no, it's not going to happen, but unfortunately, it's a part of life in the United States and other parts of the world. There's always been recessions every so many years, and it seems like we've been overdue for one for a while, and now it's definitely seems like it's here. You have had two, not just one, but two financial entities just go down, which was one. The first one is Silicon Valley Bank. I believe they are out of they're in Silicon Valley where all the tech people are at. And the second one is Signature Bank. I believe they're out of New York. They have a couple branches out here, but those are two financial banks that just don't have enough money to pay the people. They had a run at the bank. You'll hear that phrase being used a lot. And a run with the bank is a term that was coined back in the Great Depression, back in 1929, when the financial institution of the United States was just crashing. That's when you had the Great Crash, right? And what happened was people were literally running to the bank to get their money out before the bank shut down because once the panic happened, it was done. The banks were done, and that's where the term was coined, run at the bank. And that's exactly what happened with Silicon Valley. People started getting wind of them not being able to pay their money out. They started trying to sell some stocks and bonds. And as soon as word got out, everybody started taking their money out. The federal government got wind of it as well, of course. They shut it down. They closed the bank down, which meant nobody can deposit, nobody can take any money out as well. Well, soon thereafter, you had the same thing as Signature Bank, and that's a scary thought. One thing is to have one bank fail. There can always be some reason for that bank, but when you get two banks in 1 week, that starts telling the tale of the story. And the tale of the story is this: it seems like everything's starting to catch up to us. Let's go ahead and hear what the president's got to say.
I want to briefly speak about what's happening in Silicon Valley Bank and Signature Bank. Today, thanks to the quick action of my administration over the past few days, Americans can have confidence that the banking system is safe. Your deposits will be there when you need them. Small businesses across the country, the deposit accounts at these banks can breathe easier knowing they'll be able to pay their workers and pay their bills. And their hardworking employees can breathe easier as well. Last week, when we learned of the problems of the banks and the impact they could have on jobs of small businesses and banking system overall, I instructed my team to act quickly to protect these interests. They've done that. On Friday, the government regulator in charge, the FDIC, took control of Silicon Valley Bank's assets. And over the weekend, it took control of Signature Bank's assets. Treasury Secretary Yellen and a team of banking regulators have taken action, immediate action. And here are the highlights. First, all customers who had deposits in these banks can rest assured they'll be protected and they'll have access to their money as of today. That includes small businesses across the country that bank there and need to make payroll, pay their bills, and stay open for business. No losses will be, and this is an important point, no losses will be borne by the taxpayers. Let me repeat that. No losses will be borne by the taxpayers. Instead, the money will come from the fees that banks pay into the Deposit Insurance Fund. Because of the actions that our regulators have already taken, every American should feel confident that their deposits will be there if and when they need them. Second, the management of these banks will be fired. If the bank is taken over by FDIC, the people running the bank should not work there anymore. Third, investors in the banks will not be protected. They knowingly took a risk, and when the risk didn't pay off, investors lose their money. That's how capitalism works. And fourth, there are important questions of how these banks got into the circumstance in the first place. We must get the full accounting of what happened and why those responsible.
So he's pretty much trying to ease anybody's worries. And that's what a president is supposed to do. It doesn't matter what administration, what party. anytime a situation like this happens, the president's job is to ease the worries because that's really how the economy runs. The economy runs off of the consumer being confident that their money is in a safe place because the last thing any government wants is for people to go run to the bank, start pulling their money out in fear because then you will really have a crash like no other. As far as looking into what's happening, they know what's going on. There's so many loopholes in banks, and at the end, people are getting fired. No, people need to go to prison. People need to go to jail. How many people went to prison or jail for the last crash where they were, making all these fake home mortgage loans and they couldn't even figure out where they were selling them, who was buying them? I think maybe one person, and it wasn't even really much to do with it. So pretty much people at the top continue to do what they do. And if this does continue to be a trend and more banks start going down, I can guarantee you the taxpayers will be liable. It sounds good to sit there and say the taxpayers won't pay for any of this, but I kind of don't believe that whole part. But now I want to look into see what's really going on in America, not just at these banks, but what is the catalyst for these things going under. And I think some of this, like in the car dealership, this is the first time in history that so many people are paying $1,000 payments on their car vehicles. And let's look at that video real quick.
We wanted to find out what dealers think about all this, so we went to Scott Adams Toyota just outside of Kansas City. We've talked with Scott a number of times over the years. He thinks this is crazy, for the most part, that people have lost their minds in terms of some of the financing. Some of the people, he says, they can afford it. Other people, they say we just want to roll it all in there, especially on 7- and 8-year loans. Here's Scott's take on the consumer these days.
What we've noticed, especially here in the last 45 days with the Federal Reserve raising rates, that at least 50% of our customers are having payments over $1,000 a month. When you include sales tax and sometimes property tax, it's even more than that. So it's at least 50% of the cars and trucks that we are selling, because most of them are sold in advance.
Think about that. More than half of the vehicles he is selling right now, people are paying at least $1,000 a month for their monthly payment when it comes to that.
That is an issue when half of the people at the dealership are having payments over $1,000 a month. It went from like a 3-year loan, a 5-year loan. Now we're going to a 7 or 8-year loan. And the reason people are getting those 7-year, 8-year loans, and the reason the banks are giving those loans is they don't qualify for 5-year loans anymore, especially the way the interest rates have gone up so quickly. So now what the bank's trying to do is say, hey, I'll get you in that car, but now it's going to take you 7 to 8 years. And in reality is that's even going to be a worse issue in about 4 to 5 years, because a lot of cars, once they hit that 100,000 mile mark, most people, unfortunately, don't do all the maintenance on them. They'll start having transmission problems. They'll start having engine problems. They'll start having all kind of problems. And then you're still on the hook for this car for the next 3 or 4 years because you got an 8-year loan on this bad boy. That's going to eventually make that market crash. So also when you have a payment of $1,000, and a lot of these people are living paycheck to paycheck. Anybody living paycheck to paycheck should not be having $1,000 a month car payment. But unfortunately, that is just too often in our communities, right? So that's one issue that's showing you what's going on out there. Another huge indicator that we're headed towards a pretty good recession is the market as far as mortgage applications go. It is at a 28-year low. Okay, listen to that again. Applications for mortgages are at a 28-year low. That means this bus that has been pushing so fast with the housing market, it just went woo. It just slowed down by quite a bit. It has slowed down, like I said, 28-year low. That is huge. And that is also a reflection of what's going on in not the manufacturing market, but the commercial market. The commercial market leasing is also at an all-time low. And even if you don't follow these type of numbers as a regular consumer, as a regular American, all you got to do is look at your bills. This year, even in the last month, was the highest electrical bill I've ever gotten, right? or my wife, has ever had. It toppled like maybe twice as much as we ever have when we got solar panel. Same thing with our gas bill. The gas bill has gone higher than it ever has. Our food bill going to the market's higher than it's ever been. The fuel is higher than it's ever been. Everything and anything is getting higher and higher. Like I've said before, all that free money that we thought we were getting, or people thought we were getting, there's no such thing as free money, and we're starting to see this. So this is the second bank in 1 week's time. If we see a third one go down, then we know we're in for huge problems. What I would tell people, and this is just advice, I would tell them to watch your spending. I would tell them to make sure you don't go out and buy that new car just yet. I would not definitely go out and buy a new house right now. Right now, the market is very volatile. It seems like the interest rates are going to go much higher. I would try to get some of those credit cards paid off much sooner. And now that we're talking about credit cards, that's another thing. The credit cards have jumped in what we owe. I think, let me see what it was. Credit card bills jumped 61 billion from 925 million to 986 billion, the biggest jump in credit card debt since the New York Fed began tracking in 1999. So that one quarter, it jumped so much, which means people can't afford to pay this stuff cash. People can't afford to just write that check for it. People are running their credit card to make those car payments. People are running their credit card to make that food payment. This is something that is going to affect everybody and anybody. So like I said, my advice is just to sit there and be very cautious with your money. Don't go to the bank and start taking your money out unless you got over 250 grand. And if you're on that scale, you should have an account working with you, as I would assume. But if you got money in the bank, it'll be fine. It'll be federally insured. But just watch where and when you spend your money, because there is hard times coming. At least that's in my opinion. Hopefully I'm wrong, because if I'm wrong, that means we're doing hunky-dory, which will be great for all of us, right? Now I would just ask to leave a comment in the section. Let me know what you think. Let me know where you agree with me, where you disagree with me, and let me know what you think is going to happen in the future. With that being said, make sure to like, share, and subscribe so I can keep on bringing you this content. You guys have a good one, and God bless.